There are at least 5 decisions the average American retiree makes about their Social Security benefits that are costing them real money every single year. Not small amounts, not a few dollars here and there, thousands of dollars, in some cases tens of thousands of dollars over the course of a retirement. And the reason almost nobody catches these mistakes is not that the people making them are careless or uninformed. It is that the Social Security Administration has no financial incentive to correct them. The financial industry is not built around fixing them, and the rules that create them are buried in a system most retirees were never taught to understand. And before I say another word, I need to address the assumption that is about to make half of you tune out. Some of you are going to hear the words Social Security mistakes and assume this video is about timing, about when to claim, about whether to take benefits at 62 or 66 or 70. That is not what this video is about. The timing question has been covered 1,000 times. I'm not here to give you the same answer everyone else gives you. This video is about 5 different mistakes, 5 decisions that happen after you file, after the check starts arriving, after most retirees assume the hard part is done. These are the mistakes that are already costing people who are currently collecting benefits, people whose checks are arriving every month right now, people who believe everything is working correctly and have no idea that 5 specific decisions, some of which they made years ago without realizing it, are quietly reducing the amount of money that reaches their bank account every single month. And I want to be direct about who this affects, because both groups of retirees watching this are losing money in different ways. And I want to be specific about each one. Lower income retirees are losing money primarily through overwithholding, through missed benefit adjustments, and through a program elimination that most of them never knew existed. Comfortable middle-class retirees are losing money primarily through the taxation cascade, through a Medicare interaction that almost nobody explains, and through a coordination mistake that costs married couples thousands of dollars a year. I am going to walk through all 5 of them, tell you exactly which group each one hits hardest, and tell you exactly what to do about each one. The reason the financial industry does not fix these mistakes is simple. None of them require you to buy anything. None of them generate a commission for an advisor. None of them create revenue for a brokerage or an insurance company. They require knowledge and a phone call or a form, which means the people who profit from your financial decisions have zero reason to bring them up. And the government agency responsible for your benefits has too few employees and too much volume to track them down individually. In the next 20 minutes, I'm going to walk through every single one of them in plain English. And then I am going to give you 3 bonus moves at the end for the retiree who has built up some assets, because those last 3 interact directly with Social Security in ways that can put thousands of dollars back in your pocket, and almost nobody in the financial media explains them to ordinary people. Here is the one idea that connects all 5 mistakes. Social Security is not a set-it-and-forget-it system. The check arrives every month, and that feels like confirmation that everything is working. It is not confirmation. It is the baseline. The question is whether you are getting the right amount, taxed at the right rate, coordinated with the right programs in the right way. For most retirees, the answer to at least one of those questions is no, and the gap between what you are receiving and what you should be receiving is money that the system is not going to recover for you automatically. My name is Marcus Steele. I am an enrolled agent licensed by the federal government to represent taxpayers directly in front of the Internal Revenue Service. I work every week with retired clients on Social Security taxation, Medicare coordination, and retirement income planning. And the pattern that costs people the most money is never the dramatic mistake. It is the quiet one, the one that has been running in the background for years without a single alert, a single notice, or a single dollar of refund. Let us go through them one at a time. Mistake number 1 is overwithholding federal tax from your Social Security check. When you filed for Social Security, or at some point after you started receiving benefits, you may have filled out a form called the W-4V. That form tells the Social Security Administration to withhold a flat percentage of your monthly benefit for federal income tax. The available options are 7%, 10%, 12%, or 22%. Most people who fill it out pick 10 or 12% because it sounds reasonable and because they are trying to avoid owing money at tax time. Here's the problem. The withholding is a flat percentage of your gross benefit. It has no relationship to your actual tax liability. It does not account for your deductions. It does not account for the senior bonus deduction that now reduces taxable income by $6,000 per person. It does not account for whether your provisional income is above or below the thresholds that determine how much of your Social Security is taxable in the first place. It is just a number you picked, applied to your check, every month, regardless of whether it bears any resemblance to what you actually owe. The result is that millions of retirees are withholding more federal tax from their Social Security than they will ever owe, handing the government an interest-free loan every month, and then receiving a refund the following spring that they treat as a windfall when it was their own money the entire time. This hits the lower-income retiree hardest because, for many of them, particularly after the new senior bonus deduction went into effect in 2025. The correct amount of federal tax they owe on their Social Security is zero. And they are still having 10 or 12% withheld from every check because they filled out the W-4V years ago and nobody told them to revisit it. The fix is free and takes about 15 minutes. Calculate your actual tax liability on your Social Security based on your total income picture, including the new deductions. If you owe nothing, file a new W-4V with the Social Security Administration to stop withholding entirely. If you owe a modest amount, adjust to the 7% option and verify it matches your real liability. The form is available at ssa.gov and can be mailed or submitted in person. Every month, you continue over withholding as a month the government holds your money at 0% interest, while your bank account runs lower than it has to. That is mistake number 1. Mistake number 2 is failing to claim the windfall elimination provision repeal. And this is the one that the Social Security Administration has been quietly processing for over a year, while millions of people who are owed money do not know to ask for it. In January of 2025, Congress passed the Social Security Fairness Act. That law eliminated 2 provisions that had been quietly reducing Social Security benefits for certain retirees for decades. The first provision was called the Windfall Elimination Provision. The second was called the Government Pension Offset. Here is who those provisions affected. If you worked in a job that did not pay into Social Security, such as many state and local government positions, certain school district jobs, federal civil service positions from before 1984, or similar public sector roles, and you also earned a Social Security benefit from other work during your career, the windfall elimination provision was reducing your Social Security benefit, sometimes by a small amount, sometimes by several $100s a month. The government pension offset affected something different. If you received a pension from a non-Social Security covered job, and you were entitled to Social Security spousal or survivor benefits based on your spouse's record, the government pension offset was reducing or eliminating those spousal and survivor benefits entirely. In many cases, it eliminated them completely, leaving surviving spouses with no Social Security income from a marriage that lasted 30 or 40 years. Both of those provisions are gone now. Eliminated by law in January of 2025, the Social Security Administration has been processing retroactive payments and benefit increases for affected retirees throughout 2025 and into 2026. If you or your spouse worked in public education, state or local government, certain federal positions, or any job that paid into a pension system that was separate from Social Security, and if your Social Security benefit was reduced, or your spousal benefit was eliminated under the old rules, you may be owed retroactive payments going back to the date of the repeal, and you may be entitled to a higher monthly benefit going forward. The Social Security Administration is supposed to identify affected beneficiaries and process the corrections automatically. Many have been processed, many have not. The agency is understaffed, processing a backlog that stretches across months, and the volume of affected cases is enormous. If you believe you were affected by either of these provisions and you have not received a letter confirming a benefit increase or a retroactive payment, call the Social Security Administration directly and ask. Do not assume the correction happened automatically. Verify it. For retirees affected by the government pension offset who lost spousal or survivor benefits entirely, this is not a small adjustment. This is the restoration of income that was eliminated, sometimes completely, for people whose only error was working in the public sector. Some affected retirees are entitled to thousands of dollars in retroactive payments, plus a permanent increase in their monthly benefit going forward. That is mistake number 2. Mistake number 3 is paying taxes on Social Security income because of a withholding decision on a completely different account. And this one hits the comfortable middle-class retiree the hardest because it is invisible until someone maps the entire income picture at once. Here is how it works. Your Social Security taxation depends on your provisional income, which is your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefit. That single number determines whether 0%, 50%, or 85% of your Social Security is counted as taxable income. The critical point that most retirees miss is that every source of income feeding into your adjusted gross income pushes that provisional income number up. Your IRA distributions, your pension, your investment dividends, your interest income. Every one of those feeds the calculation that determines how much of your Social Security gets taxed, which means a decision you make about your IRA, completely unrelated to Social Security, can directly increase the tax you pay on your Social Security benefit. A retiree who takes a larger IRA withdrawal one year to renovate a kitchen does not just pay tax on the extra IRA income. They also pay more tax on their Social Security because the larger IRA withdrawal pushed their provisional income above a threshold. The two income sources are taxed separately in most people's minds. In the tax code, they are connected. And most retirees, and frankly, most tax preparers, who only look at 1 year at a time rather than the full retirement income picture, never map that connection explicitly. The practical move is this. Before you take any significant distribution from a traditional IRA, before you realize a large capital gain, before you make any financial decision that increases your adjusted gross income in a meaningful way, run the provisional income calculation. Know where you stand relative to the $25,000 lower threshold and the $34,000 upper threshold for single filers, or the $32,000 and $44,000 thresholds for married couples. And understand that every dollar you add to your AGI through any source is a dollar that may also increase the tax on your Social Security. This is not about avoiding tax. It is about coordinating decisions across income sources that the system treats as separate but that the tax code connects. The retiree who does this coordination pays what they owe. The retiree who does not often pays significantly more year after year without ever receiving a letter explaining why. That is mistake number 3. Mistake number 4 is missing the Medicare premium appeal after retirement. And this one is specific to the retiree who worked at a meaningful income level and retired within the last 2 years. Medicare uses your tax return from 2 years ago to set your Part B and Part D premiums. If your income 2 years ago was above $106,000 as a single person or above $212,000 as a married couple, you are paying a surcharge on top of the standard Medicare premium. That surcharge is called IRMAA, the income-related monthly adjustment amount. At the highest income tier, it adds nearly $578 a month per person to your Medicare cost. The 2-year look-back means that if you retired last year and your income dropped dramatically when you stopped working, Medicare is still charging you a surcharge based on the salary you no longer earn. The surcharge is calculated on income that is gone, and it will continue until Medicare catches up to your current income, which, under the standard look-back rule, takes 2 years. Except there is a form that shortens that window to weeks. The form is called the SSA 44. It is a free download from SSA.gov. It allows you to request that Medicare recalculate your premium based on your current income rather than the 2-year look-back income. To qualify, you must have experienced a qualifying life-changing event. Retirement is on the list. So is the death of a spouse, a divorce, and a significant reduction in income. The form requires documentation of the qualifying event and an estimate of your current year income. I have walked clients through this form who were paying $400, $500, $600 a month in Medicare surcharges based on income they had not earned in over a year. Filing the SSA 44 with proper documentation stopped the surcharge within weeks in most cases. The savings in the first year alone were between $4,000 and $7,000 per person. And the form itself takes 15 minutes to complete. If you retired in 2024 or 2025, if your income dropped significantly when you stopped working, and if you are currently paying Medicare premiums that seem higher than you expected, look at your Medicare premium notice and check whether an IRMAA surcharge is included. If it is, and if your current income is below the threshold, the SSA 44 is waiting. That is mistake number 4. Mistake number 5 is the coordination error that quietly reduces Social Security income for married couples. And it is the one that I see most often, and that costs the most money over long retirement. In a married household where both spouses are collecting Social Security, there's a benefit called the spousal benefit. If one spouse's own benefit is less than 50% of the other spouse's full retirement age benefit, that lower earning spouse may be entitled to a higher payment based on the spousal benefit calculation rather than their own work record. Most married couples where both spouses worked know this rule exists. What they do not know is that the spousal benefit calculation is not automatic in all circumstances, and that certain filing combinations reduce or eliminate the spousal benefit through an interaction with when each spouse claimed their benefits. Here's the specific situation that costs people the most money. Both spouses claim early. Both take benefits at 62 or 63 because the money is needed and because the immediate income matters. Both benefits are reduced for early claiming. And when the lower earning spouse's reduced early benefit is compared to 50% of the higher earner's reduced benefit for the spousal calculation, the numbers produce a lower result than they would have if at least one spouse had waited to claim at a later age. I'm not going to tell you that claiming early is always wrong. For many couples, it is the right decision given health, income needs, and life expectancy. But I'm going to tell you that the interaction between spousal benefits and early claiming is almost never explained clearly before people make the decision, and that the combination of both spouses claiming early is the specific pattern that most commonly results in a household leaving a meaningful amount of money on the table over a 20 or 25-year retirement. The move for a married couple approaching the claiming decision is to map out the spousal benefit calculation explicitly under multiple claiming scenarios before making either decision. Not after one spouse files, before. Because once the higher earning spouse files, the spousal benefit ceiling for the lower earner is set. You cannot raise it by waiting after the fact. And for couples who are already both collecting and who claimed early, the damage is done for the primary benefit amounts. But understanding the survivor benefit calculation is still essential. When one spouse passes, the surviving spouse retains the higher of the two benefit amounts, which means the claiming strategy of the higher earner has a direct impact on the income of the survivor for the rest of their life. A surviving spouse living on the higher earner's reduced early benefit for 10 or 15 years is living on less than they would have if the higher earner had waited. That is money that compounds across every remaining year of the survivor's life. For couples who have not yet both claimed and are planning, get the spousal benefit calculation in writing under at least 3 scenarios before making either decision. The Social Security Administration will provide this information. Your financial advisor should be providing it. If neither is offered it, ask specifically. The numbers may change the decision. That is mistake number 5. Now I promised you 3 bonus moves, and I want to be precise about who these are for. The 5 mistakes I just covered hit retirees across every income level in different ways. These bonus moves are specifically for the retiree who has built up meaningful assets alongside Social Security, a traditional IRA with a real balance, investment accounts, charitable giving as a regular part of life. If that description fits you, these 3 moves interact directly with your Social Security benefit in ways that can be worth far more than anything else I covered today. Bonus, move number 1, is the Roth conversion window and its direct impact on Social Security taxation. Between retirement and age 73, when required minimum distributions begin, your income is often at its lowest point since you started working. Your salary is gone. Your IRA distributions are voluntary. Your capital gains are under your control. That combination creates a window where your provisional income may be below the Social Security taxation thresholds, or just above the lower threshold, rather than above the upper one. In that window, converting a portion of your traditional IRA to a Roth IRA each year pays the tax now at the lower bracket. And once the money is in the Roth, it never appears in your provisional income calculation again, which means your Social Security taxation in future years is lower than it would have been if the money had stayed in the traditional IRA and come out as required distributions later. The conversion costs you tax today. It saves you tax on the Roth distribution and on your Social Security for the rest of your retirement. Done carefully over a 5 to 7 year window, staying below the upper Social Security taxation threshold each year, this single strategy can reduce a retiree's lifetime Social Security tax burden by tens of thousands of dollars. Bonus. Move number 2 is the qualified charitable distribution and its effect on provisional income. If you are 70 and a half or older, give to charity, and have money in a traditional IRA, sending that charitable giving through a qualified charitable distribution from your IRA, rather than writing a check from your bank account, removes that money from your adjusted gross income entirely, not as a deduction, as an exclusion. The money leaves the IRA, goes to the charity, and never appears in the income calculation that determines how much of your Social Security is taxed. A retiree who gives $10,000 a year to charity and routes that giving through a qualified charitable distribution reduces their provisional income by $10,000. Depending on where that reduction falls relative to the Social Security taxation thresholds, the downstream reduction in Social Security taxes can be $2,000 or more per year from giving the same amount of money to the same causes. The only difference is which account the check comes from. Bonus move number 3 is the most important of the 3 for the retiree who is still in the early years of collecting Social Security and has not yet had a professional review the full income picture. That review is the bonus move, not a product, not an investment. A single comprehensive look at all of your income sources simultaneously, mapped against the Social Security taxation thresholds, the Medicare IRMAA thresholds, the provisional income formula, and the new senior deductions that went into effect in 2025. Most retirees have never had that conversation. Their tax preparer looks at last year's return and files this year's return. Their financial advisor manages the investment account. Their insurance agent handles Medicare. Nobody looks at all of them at once and asks how the decisions in one column are affecting the numbers in every other column. That single conversation with someone who understands how these systems interact is what catches the over-withholding that has been running for years. It is what identifies the IRMAA appeal that needs to be filed. It is what maps the provisional income picture that shows the Roth conversion opportunity. It is what finds the spousal benefit calculation that nobody ran before both spouses claimed. It does not require an ongoing relationship. It does not require a product purchase. It requires one meeting with one person who knows how to read the full picture. For most retirees I work with, that meeting identifies between $2,000 and $8,000 of annual adjustments that nobody had flagged before. Let me bring all of this together with the one point that matters more than any specific rule I covered today. Social Security is the most important financial program in most retirees' lives. It is the check that arrives every month for the rest of your life. It adjusts with inflation. It does not run out. It is the foundation, and it is being quietly reduced, overtaxed, miscalculated, and miscoordinated for millions of retirees who have no idea anything is wrong because the check keeps coming and nobody sends a notice when the amount could be higher. The government does not send you a letter saying your withholding is too high. The Medicare system does not flag itself when the surcharge is based on income you no longer earn. The Social Security Administration does not call to tell you the windfall elimination provision repeal may entitle you to retroactive payments. The tax code does not alert you when your IRA decisions are cascading into higher Social Security taxes. The check arrives. You deposit it. You assume it is correct. It may not be. Before I close, I want to give you something to take with you. I put together a free resource, my 2026 Retirement Income Protection Checklist. It covers the W-4V withholding review process, step by step, the windfall elimination provision and government pension offset repeal, and how to verify whether you are owed retroactive payments, the provisional income calculation worksheet with the exact thresholds that determine your Social Security tax, the SSA 44 filing instructions for the Medicare premium appeal, and the spousal and survivor benefit scenarios every married couple needs to run before making the claiming decision. Every item includes the form, the phone number, and the deadline where one applies. To get it, go to marcusgravestacks.com/checklist. The link is also in the description below. Print it out and go through it this week. Because every month that passes with a mistake running is a month of money you cannot recover. Here is what I want to leave you with. Every one of the 5 mistakes I described today is fixable. The overwithholding can be corrected with a single form. The windfall elimination provision repeal can be verified with a single phone call. The provisional income cascade can be managed with a single planning conversation before the end of the tax year. The Medicare appeal can be filed in 15 minutes. The spousal benefit calculation can be run before either spouse files. None of them require a financial product. None of them require a large upfront investment. They require knowledge and action. And the only reason most retirees never take the action is that nobody ever handed them the knowledge. You have the knowledge now. Send this video to one person in your life who is over 65 and collecting Social Security. A parent, a neighbor, a friend, a sibling. The odds are very good that at least one of these 5 mistakes is running in their account right now. And one share from you today could be worth thousands of dollars to someone who has been quietly losing money without ever knowing why. That is what this channel is here to do. I will see you in the next one.